Hello, and welcome back to Educational Psychology channel. In today's video, we'll be delving into the fascinating topic of the psychology of investor behavior. Investing can be a complex and challenging endeavor, influenced not only by market forces, but also by our own thoughts, emotions, and biases. Understanding the psychology behind investor behavior is crucial for making informed financial decisions. So, let's dive right in. Section 1. Introduction to investor behavior. Before we explore the intricacies of investor behavior, let's start with a basic understanding of what it entails. Investor behavior refers to the actions, decisions, and attitudes that individuals exhibit when investing their money in financial markets. It encompasses a wide range of factors, including cognitive biases, emotional responses, risk tolerance, and information processing. Section 2. Cognitive biases. One of the primary drivers of investor behavior is cognitive biases. These biases are systematic errors in our thinking processes that can lead to irrational investment decisions. Let's discuss some common cognitive biases and their impact on investors. Subsection 2.1. Confirmation bias. Confirmation bias is the tendency to search for, interpret, and favor information that confirms our pre-existing beliefs or opinions. In the context of investing, this bias can lead investors to seek out information that aligns with their existing investment choices, ignoring or downplaying contradictory evidence. This can hinder objective decision-making and result in suboptimal investment outcomes. Subsection 2.2. Loss aversion. Loss aversion refers to our natural inclination to feel the pain of losses more intensely than the pleasure of gains. Investors who are highly loss-averse may be reluctant to sell losing investments, hoping for a rebound, even when it's not supported by rational analysis. This aversion to realizing losses can lead to a phenomenon known as the sunk cost fallacy. Subsection 2.3. Herding behavior. Herding behavior occurs when investors follow the actions of the crowd rather than conducting independent analysis. This behavior often stems from the fear of missing out or the assumption that everyone can't be wrong. Herding can amplify market volatility and lead to speculative bubbles or sudden market crashes. Section 3. Emotional influences. Investors' emotions play a significant role in decision-making. Let's explore how certain emotions can impact investor behavior. Subsection 3.1. Fear and greed. Fear and greed are two dominant emotions that can drive investor behavior. Fear can cause investors to panic sell during market downturns, leading to substantial losses. Conversely, greed can drive investors to take excessive risks in pursuit of high returns, often overlooking the potential downsides. Both emotions can distort rational decision-making and result in suboptimal investment choices. Subsection 3.2. Overconfidence. Overconfidence is another emotional bias that can influence investor behavior. Overconfident investors tend to overestimate their knowledge and abilities, leading them to make overly optimistic investment decisions. This bias can lead to excessive trading, poor diversification, and a failure to adequately assess risk. Section 4. Risk perception and tolerance. Individuals' perception of risk and their tolerance for it also play a crucial role in investor behavior. Let's examine these factors in more detail. Subsection 4.1. Prospect theory. Prospect theory suggests that individuals weigh potential losses and gains differently. The theory posits that people experience the pain of a loss more intensely than the pleasure of an equivalent gain. This leads to risk aversion when facing potential gains and risk-seeking behavior when facing potential losses. Understanding how investors perceive and evaluate risk is essential for predicting their behavior in different market conditions. Subsection 4.2. Risk tolerance. Risk tolerance refers to an individual's willingness to take on investment risks. It varies from person to person and is influenced by factors such as age, financial situation, investment goals, and personality traits. Investors with a high risk tolerance are more likely to pursue aggressive investment strategies, while those with low risk tolerance tend to opt for safer, more conservative options. Section 5. Information processing. The way investors process and interpret information significantly impacts their behavior in the financial markets. Let's explore some key aspects of information processing in investor decision-making. Subsection 5.1. Availability bias. Availability bias occurs when investors rely heavily on readily available information rather than conducting thorough research. This bias can lead to distorted perceptions of market trends and missed opportunities, as investors may overlook less accessible or less widely known information. Subsection 5.2. Anchoring bias. Anchoring bias refers to the tendency to rely heavily on the first piece of information encountered when making decisions. In the context of investing, investors may anchor their decisions to initial price levels or expert opinions, failing to reassess their choices based on new information. This bias can result in missed opportunities or holding onto investments longer than warranted. Subsection 5.3. Framing effect. The framing effect suggests that the way information is presented can influence investor decisions. Investors may react differently to the same information depending on how it is framed, emphasizing potential gains or losses. This bias can lead to irrational decision-making based on the emotional response to how information is presented. Section 6. Overcoming behavioral biases. While behavioral biases are inherent in human psychology, there are strategies that investors can employ to mitigate their impact. Let's discuss some techniques for overcoming these biases. Subsection 6.1. Education and awareness. Education and awareness are essential for investors to recognize and understand their own biases. By learning about common cognitive and emotional biases, investors can become more mindful of their decision-making processes and make more rational choices. Subsection 6.2. Diversification and asset allocation. Diversification and asset allocation are effective risk management techniques that can help investors mitigate the impact of cognitive biases. By spreading investments across different asset classes and geographies, investors can reduce the risk associated with individual investments and minimize the impact of short-term market fluctuations. Subsection 6.3. Long-term focus and patience. Maintaining a long-term perspective and practicing patience is crucial for overcoming emotional biases. By focusing on long-term goals and avoiding impulsive reactions to short-term market fluctuations, investors can make more rational decisions and stay committed to their investment strategies. Understanding the psychology of investor behavior is a vital component of successful investing. By recognizing and managing cognitive biases, emotional influences, risk perception, and information processing, investors can navigate the complex world of finance with greater confidence and achieve their financial goals. Thank you for watching. We hope you enjoyed this video. If you found this video helpful or entertaining, don't forget to hit that like button and subscribe to our channel for more content like this.